I mean, let's just say,
Trade-off.
that if you take taxes to zero for everybody in the country, you would be issuing a lot of bonds. You can't ever do just one thing in economics.
4 of the biggest investment tips from Warren Buffett. Hey guys, welcome back to Financial Professional. Today we'll talk about 10 of the biggest investment tips from Warren Buffett. Let's head into it. Number 4, invest in what you know and nothing more.
It's not that we were non-competitive before, but our shareholders are better off.
One of the easiest ways to make an avoidable mistake is getting involved in investments that are overly complex. Many of us have spent our entire careers working in no more than a handful of different industries. We probably have a reasonably strong grasp on how these particular markets work and who the best companies are in the space. However, the far majority of publicly traded companies participate in industries we have little to no direct experience in. Never invest in a business you cannot understand, says Warren Buffett. This doesn't mean we can't invest capital in these areas of market, but we should approach with caution. In my view, the far majority of companies operate businesses that are too difficult for me to comfortably understand. I'll be the first one to tell you that I cannot forecast the success of a biotechnology company's drug pipeline, predict the next major fashion trend in teen apparel, or identify the next technological breakthrough that will drive growth in semiconductor chips. These types of complex issues materially affect the earnings generated by many companies in the market, but are arguably unforecastable. When I come across such a business, my response is simple: pass. There are too many fish in the sea to get hung up on studying a company or industry that is too hard to understand. That is why Warren Buffett has historically avoided investing in the technology sector. If I cannot get a reasonable understanding of how a company makes money and the main drivers that impact its industries within 10 minutes, I move on to the next idea. Of the 10,000 plus publicly traded firms out there, I estimate that no more than a few hundred companies meet my personal standards for business simplicity. Peter Lynch once said, "Never invest in an idea you can't illustrate with a crayon." Many mistakes can be avoided by staying within our circle of competence and picking up a Crayola.
If I were frustrated with my ability to talk to the people I'm responsible for, the president feels that way.
Number 3, never compromise on business quality. While saying no to complicated businesses and industries is fairly straightforward, identifying high-quality businesses is much more challenging. Warren Buffett's investment philosophy has evolved over the last 50 years to focus almost exclusively on buying high-quality companies with promising long-term opportunities for continued growth. Some investors might be surprised to learn that the name Berkshire Hathaway comes from one of Buffett's worst investments. Berkshire was in the textile manufacturing industry, and Buffett was enticed to buy the business. He believed that if you bought a stock at a sufficiently low price, there will usually be some unexpected good news that gives you a chance to unload the position at a decent profit, even if the long-term performance of the business remains terrible. With more years of experience under his belt, Warren Buffett changed his stance on cigar butt investing. He said that unless you are a liquidator, that kind of approach to buying businesses is foolish. The original bargain price probably will not turn out to be such a steal after all. In a difficult business, no sooner is one problem solved than another surfaces. These type of companies also usually earn low returns, further eroding the initial investment's value. These insights led Buffett to coin the following well-known quote: "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price," says Warren Buffett. One of the most important financial ratios that I use to gauge business quality is return on invested capital. Companies that earn high returns on the capital tied up with their businesses have the potential to compound their earnings faster than lower returning businesses. As a result, the intrinsic value of these enterprises rises over time. Time is the friend of the wonderful business, the enemy of the mediocre, says Warren Buffett. High returns on capital create value and are often indicative of an economic moat. I prefer to invest in companies that generate high, like 10 to 20% and stable returns on invested capital, instead of giving into the temptation to buy a dividend stock yielding 10% or snap up shares of a company trading for just 8 times earnings. Be sure you are comfortable with the company's business quality.
How do you tell the difference between reasonable and unreasonable fear?
Well, you just keep looking at the facts. If the snow's 2 feet out and there's no business today, do you say, well, I made a terrible deal? No, I mean, you're looking at a business.
Number 2, when you buy a stock, plan to hold it forever. Once a high-quality business has been purchased at a reasonable price, how long should it be held? If you aren't thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes, says Warren Buffett. Our favorite holding period is forever, says Warren Buffett. If the job has been correctly done, when a common stock is purchased, the time to sell is almost never. Warren Buffett clearly embraces a buy and hold mentality. He has held some of his positions for a number of decades. Why? For one thing, it's hard to find excellent businesses that continue to have a bright long-term future. Buffett runs a concentrated portfolio for this reason. Furthermore, quality businesses earn high returns and increase in value over time. Just like Warren Buffett said, time is the friend of the wonderful business. Fundamentals can take years to impact a stock's price, and only patient investors are rewarded. Finally, trading activity is the enemy of investment returns. Constantly buying and selling stocks eats eats away at returns in the form of taxes and trading commissions. Instead, we are generally better off to buy right and sit tight. The stock market is designed to transfer money from the active to the patient, says Warren Buffett. Number 1. Diversification can be dangerous.
I stick with what I know. If somebody owns 50 stocks, the one they rank as number 50 as well as the one they rank as number 1, can they know it as well? I don't think so.
In my view, individual investors gain most of the benefits of diversification when they own between 20 and 60 stocks across a number of different industries. However, many mutual funds own hundreds of stocks in a portfolio. Warren Buffett is the exact opposite. Back in 1960, Buffett's largest position was a whopping 35% of his entire portfolio. Simply put, Warren Buffett invests with a conviction behind his best ideas and realizes that the market rarely offers up great companies at reasonable prices. You will notice that our major equity holdings are relatively few. We select such investments on a long-term basis, weighing the same factors as would be involved in the purchase of 100% of an operating business. Number 1. Favorable long-term economic characteristics. Number 2. Competent and honest management. Number 3. Purchasing price attractive when measured against the yardstick of value to a private owner. And number 4. An industry with which we are familiar and whose long-term business characteristics we feel competent to judge. It is difficult to find investments meeting such a test, and that is one reason for our concentration of holdings. We simply cannot find 100 different securities that conform to our investment requirements. However, we feel quite comfortable concentrating our holdings in the much smaller number that we do identify as attractive, says Warren Buffett. When such an opportunity arises, he pounces. Opportunities come infrequently. When it rains gold, put out the buck, not the thimble, says Warren Buffett. On the other end of the spectrum, some investors excessively diversify their portfolios out of fear and/or ignorance. Owning 100 stocks makes it virtually impossible for an investor to keep tabs on current events impacting their companies. Excessive diversification also means that a portfolio is likely invested in a number of mediocre businesses, diluting the impact of its high-quality holdings. Diversification is a protection against ignorance. It makes very little sense for those who know what they are doing, says Warren Buffett.
It's defining what I call your circle of competence. The important thing is not how big the circle is. The important thing is staying inside the circle.
Perhaps Charlie Munger summed it up best. The idea of excessive diversification is madness, says Charlie Munger. How many stocks do you own? If the answer is more than 60, you might seriously want to consider slimming down your portfolio to focus on your highest quality holdings. What do you think about these tips? Which was your favorite one? Let us know in the comment section. This brings us to the end of our video. I hope you enjoyed it. Hit like if you did, and don't forget to subscribe to our channel so that you don't miss any of our videos in the future. Also, watch the 2 videos that are on your screen because I'm sure you'll love them. With that, I'll see you in the next video.